Alright you guys, it's Lincoln here. Welcome to the video. We're going to go over how to invest your first $1,000 in options. Before I get into this, I just want to mention real quick, this is not what I would do with the first $1,000 that I have. I would build an emergency fund and then match my company's 401k, basically pay off all high interest debt, get a little bit more in my emergency fund, and then maybe start talking about investing $1,000 in options. So this would not be my first $1,000 investment. I would get my portfolio going a little bit better, buying index funds, that sort of thing. All of this, I want this video to have that context to it. Okay, so you guys know me. You know I like selling covered calls, poor man's covered calls, and cash secured puts. Basically, this video came down to doing one of those two latter strategies. So either setting up poor man's covered call and selling covered calls using a long call as collateral, or selling cash secured puts. The trouble with selling cash secured puts with only $1,000 is you would need to do it on a stock that trades for $10 or less, or right around there. I guess you could pick a strike price that's a little bit lower than where the stock's trading. But I personally only have one stock in my portfolio that fits that criteria, and it is Priority Technology Holdings. You can see it trades for about $6.50 this morning, but there is no option selling on it because the market cap is less than the required minimum. Basically, there isn't an options chain offered on this company. So that rules out selling cash secured puts on a company like this. You could run into the same thing with quite a few other companies, maybe not ones that you're holding. So check that. If you can sell cash secured puts on one of your positions, if there's a stock that you own anyway and it's trading hands for $10 or less, or right around there, I would start by selling cash secured puts. Okay, I have quite a few videos on that on my channel, but this, we're going to talk about using the poor man's covered call. Okay, so we're going to use a long call as our collateral and then sell covered calls based on that. Okay, I'm assuming you guys know what this means a little bit. If you don't, I guess covered calls are where you own 100 shares or more of a stock, and then you sell covered calls on that, collect the premium. If the shares get called away, so be it. You enter a new position, or you enter the same position, sell a new covered call. If the option expires worthless, then you still have your 100 shares, and you sell a new covered call. So that is a typical covered call. Poor man's covered call is the exact same concept. You just use a long call as your collateral. Okay, a long call that either has a lower strike and or a longer time until expiration. Okay, I know I just blazed right through that, but if you guys have actual questions on how that works, you can easily Google it, or go to my channel or go to somebody else's channel and watch a little bit more about the poor man's covered call design. Okay, so we have $1,000 and we want to do the poor man's covered call. If you guys know me at all, you know I don't like just buying calls. I don't like buying calls. I don't like buying puts. But if I do buy an option, it is going to be a deep in the money call. I have a bunch of videos on my channel about this, but basically it gives you a very long time until expiration. The break-evens are super low, and it gives you a ton of leverage. Okay, so those are the three big reasons. If that doesn't get you excited about deep in the money leaps, deep in the money calls, I don't know what will. So check out my channel for those videos. But still, you just have $1,000, so you're pretty much going to be working with stocks that are selling for $30 a share or a little bit less than that. 30, 20, 15 to $30 a share is probably kind of the range that you're working with still. Still pretty limiting, only having $1,000 to invest in options, at least the way that I do it. But you can definitely use this strategy to do it. So you guys can see I have 3 deep in the money leaps open in my account right now that this could work with. So 3D Systems, I own a $15 call. Remember, option contracts have a 100 multiplier. These contracts represent a per share price, and each contract is worth 100 shares. So this is actually a $1,385 contract. This Dropbox one, the $20 strike, is a $1,355. And Tattooed Chef is $11.30. You can see all of these. The 3D Systems one expires in like 6 months, but the other two both expire in a year and a half, and same with my Micron one. So again, even if you do find a stock that this works for, it's kind of in that $15 to $30 range, you're going to have to check their options chain. And if it's anything like Max and Solar, this is the longest date option they go, and this is only like 7 months out. So When I'm buying deep in the money leaps, I'm buying at least a year, ideally a year and a half or 2 years away. So keep that in mind. Even if you find a stock that's in that range, you might not be able to find a leaps contract, an expiration date in that option chain that is long enough to really get the most out of this. So keep looking, try to find something that matches that criteria a little bit better. So for an example, do not copy what I do just because I did it. Let's use this tattooed chef position. So like I said, this contract is worth $1,130 right now. You can see I paid $1,170 for it. I've sold at least one covered call on it. I don't have one on it right now, but I'm basically break even on this position. So if I only had $1,000 and I decided, yep, tattooed chef, that's the one. It has the expiration date that I want. It goes out to January 2023. That is a year and a half away. I'm now going to look for a deep in the money call. What do I know is deep in the money? For me, deep in the money means a delta of 85 or higher. So that 15 strike, only had a 79. Delta here is 84, the 12.5 strike. $10 strike, 90 delta. Perfect, that fits our criteria. And then just to look at the other ones, 750, this could work too. But I want you guys to notice something real quick. So these round numbers, so $10, $15, $20, they will always have more volume than the 750, kind of the in-between range. Keep your eyes open for that. So in addition to the expiration being over a year away and that delta being in the 85 to 95 range, you want to have a contract that at least has a few contracts in the volume. And I always say at least 100 on the open interest. So volume is how many contracts have traded hands today. So just 2 of these have traded hands today. Open interest is how many have traded all time. Okay, so there's over 2,000. So there's pretty good volume here, which means the bid and the ask are not going to be that wide. The spread's actually going to be pretty solid here. So this is what I would do. You have $1,000. This contract, shoot, yeah, it costs $1,125. So let's select that. But now we need to go out and find a call to sell that can recuperate that $130 or $125 extra. So if we go near term to August, this isn't going to do much for us. I'd like to sell at this $25 to $30 strike. If we look at Tattooed Chef and kind of where it's been, this is obviously a high growth company. I like its upside, which is why I'm going long. I don't want to sell super tight because I don't want to cap my upside. So we can see all-time highs, $28 a share, $25 a share, somewhere in there. So that $25 to $30 strike is probably what we're working with Tattooed Chef at $20 a share right now. I'm fine looking at that $25 strike. So we're going to try and sell it with the shortest expiration date as humanly possible while collecting $125 to $130 a share. So we're going to have to go out a little ways. And this is kind of the hard part about buying these deep in the money leaps. They're expensive contracts. But yeah, to me, it is well worth the cost. And you guys can go to my other videos to see exactly my breakdowns on those and why I do think they're worth the cost. So it looks like we have to go all the way out to December, which is fine. I'm going to go ahead and sell this one. You can see the bid and ask are fine there. So you should be able to get $165 for this contract. So buying the $10 call at $11.25, selling the $25 call at $1.63. I'm actually going to try and get a fill at $1.60. Kind of split that bid and ask, and I think I can get a fill. So I'm going to set this at $9.60. You can see Robinhood multiplies that for you, and that is a $960 cost. Always make sure you're selling your covered call at strikes over your break even. Otherwise, you can basically lock yourself into a loss. Review order and submit. And that is that. Okay, so that is how I would invest my first $1,000 into options. Poor man's covered call with a deep in the money leaps. Okay, start selling covered calls against it. So after this call expires worthless, I'm still going to own my deep in the money leaps. I can go ahead and sell another covered call on it. Maybe sell that one with a little bit shorter expiration because we're not working with a $1,000 constraint. Okay, so that is what I would do with my first $1,000 in options. And I hope you guys Appreciated the content. Please hit the like button if you did, and subscribe if you want to see more like it in the future. And I'll catch you guys in the next video.